So did you know that Indian banks have crossed a major milestone? So the credit to deposit ratio for the whole banking industry has risen to above 80%, and this is the first time that is happening. What does it mean? Let's decode that. So to start with, what is credit to deposit ratio? So basically जितना banks में deposit होते हैं, against that how much can a bank actually lend? For example, अगर एक बैंक के पास 100 रुपए के deposits हैं and if they are lending 80 rupees as credit, so the credit to deposit ratio turns out to be 80%. Now, while this is seen as a strong economic indicator that the banks are lending aggressively and the demand is high for consumption, it also comes with a lot of risks. So, according to the RBI, the Reserve Bank of India, the CDR ratio, the credit to deposit ratio, has hit 80.21. Now, this is way higher than the RBI's comfortable range, which was around 65 to 75%. Now, what is the main reason for this happening? The number one reason is sluggish deposit growth. And RBI's data itself shows that the credit growth jumped to 11.3%, while the deposit growth fell from 10.3% to 9.7%. One of the key highlights in Indian retail investors, what Mr. Uday Kotak pointed out in June 2025, the mutual fund assets are nearly 1/3 of what the bank deposits are, and this data is as on May 2025. So just to put it in perspective, in FY15, the mutual fund AUM was nearly 13% of the bank's total deposits, but now that share has grown up to 31%. So what usually happens in scenarios like this, that the banks usually hike up the deposit rates to attract more deposits. This can also lead to some margin compression, since especially that the interest rates have started falling down and we are in an interest rate cut cycle. So this entirely means that savings might now attract higher deposit rates, while if you're an investor into banks, you should watch out, since the banks might start to face some margin compression in the upcoming months.